Yes.
Yes, yes.
Okay.
Thank you for joining us. It's a good day. So we're gonna put ourselves here. Is our first session, blockchain, with Gideon, our instructor in the Crypto PanAfrica. So we're gonna do the first session. Gideon, you can take us through what is blockchain, please.
Yeah, so blockchains are fundamentally software protocols that allow multiple parties to operate under shared assumptions and data without trusting each other. So essentially, what we're saying is that a blockchain is a database that allows different parties to be able to operate within the same ecosystem, and essentially the aspects of having to trust one another are eliminated because counterparty risk is completely eliminated. So blockchains are essentially decentralized. So if you could go back to the previous slide. So blockchains are essentially decentralized. That means that they don't have a central point of being able to be governed. So essentially what we're saying is that the distributed ledger technology, which is the underlying technology around blockchain, allows for nodes to maintain the same copy of data, right? So, and every node within that particular ecosystem has the same data that is available on this other particular node. And of course, that is where some of the attributes of blockchain come into. And of course, we're going to see those, what those are. So essentially, blockchain technology is powered by distributed ledger technology. Distributed ledger technology is a ledger that is not only available on a centralized server, but is available on every other server. Then those servers are connected, right? So they are connected. And you'll be able to see in the next slide, if you go to the next slide, you'll be able to see that each block is connected to the next block by making sure that the hash that was on the previous block is available on the preceding block. And that makes it a blockchain because they are connected. So if you were to change data on just one of the blocks, then you'd have to change data on all of them. And therefore, there exist what we call consensus mechanisms that allow for for communication and general consensus on what data needs to be changed. So whether data needs to be changed, deleted, written, all those kind of things. So store data in blocks that are changed together. So the blocks are changed together as new data comes in it is entered into a fresh block. You get it? So once you finish that block, you hash it, then you do every block contains a hash reference to the block before, as you can trace every transaction back to the genesis block, back to where it is started. So once a block is filled with data, it is changed onto the previous block. Blockchain is a subset of distributed ledger technology. So as you said, distributed ledger technology is the underlying tech that serves the blockchain, that serves blockchain. And of course, the hash is cryptographic. So of course, there is that bit of security that we're able to see. So we can move next. So this is what we call the blockchain stack. So of course, you can be able to see where the blockchain layer comes into play and how that is connected to what we call the application. So we have the operating system, which could be any of the operating systems that we have. Then we have the key assets within the blockchain. Those could be coins or tokens. Then we have the blockchain itself. Then we have APIs that connect that to the mobile application, or rather the applications that we have built, or the DApps, the decentralized applications that will be built around it. Moving forward, then we are able to see that that we have an example of an ecosystem that leverages on the blockchain data, and this is an example of a bank. So you have a bank where they have their own intranet, but B as its own intranet, but they all connect to the same blockchain, right? They connect to the same blockchain through an API. So as you saw on that particular stack, we do have what we call the applications or the DApps, but they connect to the blockchain, and then this blockchain is managed by nodes or validator nodes. So these nodes are what we call miners. So the nodes are the ones that process transactions within the blockchain. And of course, they get rewarded for doing that. And they have what we call a consensus mechanism to be able to do that. So probably it could be proof of work, proof of stake, BPFT, whatever consensus mechanism that is within that particular blockchain is what the nodes or the validators are able to do. So you have your validators here, and then you have the blockchain, which communicates with each of those institutions, right? So through APIs, and then those institutions, if they have to write data to this particular blockchain, then of course that data has to be first of all be validated. So this is generally an example of an ecosystem of a blockchain. It's been a ledger of data. So essentially, it's a database, but that is distributed. So which means that the same copy of record that is with validator A is the same record that is with validator B. And of course, the data that is being written can be accessed on the blockchain explorer. So we can move forward and be able to see some of the attributes that makes blockchain unique in terms of the kind of implementations that is done. And of course, one of them is that it's distributed. So all network participants have a full copy of the ledger for full transparency. And that's one of the key attributes that brings forth the issue of trust. There is no counterparty risk, and trust is created by the virtue that the same copy is available with every other network and with every other node within the network. And of course, there must be a consensus mechanism that ensures that for you to change the data, then that data has to be accepted by everyone else. Number two is anonymous. The rate of participants is either pseudonymous or anonymous, which means you can participate in a network without having to reveal your identity. So you don't have to be known who you are. There's no KYC that you have to do. And of course, you can participate in validating transactions within that particular network. Every transaction is time-stamped, and of course, that is able to keep records. And of course, all network participants agree to the validity of each of the records. That's what I'm talking about, a consensus mechanism, unanimous. The blockchain is unanimous, which means there is a consensus mechanism that ensures that any data that is to be written into the blockchain, then that data has to be agreed upon. And of course, the next one is that it's immutable, which means when those records are there, they are there for posterity. Those records cannot be deleted. Those records cannot be changed. And therefore, every transaction, including a transaction to change data, to replace data, to update data, is also recorded within the blockchain without having to delete the previous data. So that is what makes it very secure and very reliable in terms of storing data, and its application therefore becomes very useful on a lot of applications. All records are individually encrypted. So of course, as you've seen, there's a hash that encrypts every record that is within the blockchain. And of course, that means that that data is not accessible to anybody. So the fact that it's encrypted, then it means that it's not easily accessible unless you have a private key or a public key to decrypt it. Then you would not be able to access the data that is within the network. And of course, one of the attributes that has made blockchain become one of the best database solutions is that it's programmable, and it leverages what we call smart contracts. So smart contracts are self-executing contracts that allow for specific instructions to be executed when specific conditions are met. So when you have a self-executing blockchain, that means there is less of human interaction. And again, that speaks to the attributes of trust that have been able to be built around the blockchain technology, which makes it very, 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 very ideal for various applications that really value security, safety, trust as one of its core aspects of operation. So moving forward, we can... yes?
Can I? Excuse. There are some students asking questions. So they're asking, should they shoot the question during the lesson, or should they wait towards the end of your lesson?
Yeah, they can shoot anytime.
Okay. There is a question here that is asking, is crypto same as blockchain?
No. Crypto, or rather Bitcoin, is not blockchain. Blockchain is a technology that powers crypto. So crypto is one of the applications of blockchain technology. And essentially, if you look at Bitcoin, which is one of the pioneer blockchain implementations. But blockchain has been there since 1990, but Bitcoin came into the fold in 2008 because of the financial crisis that was there at that particular time. You'll be able to see that story in the preceding slides. Then obviously, then you can understand that it's a financial implementation of blockchain technology where people are looking at leveraging the aspects of security, the aspect of counterparty risk, anonymity, the aspects of distributed ledger, immutable transactions, to be able to bring sanity into our financial transactions. Because Bitcoin is finite in its supply. It's 21 million. It's finite with every halving. The difficulty is there. So the aspect of scarcity is there, and of course, people have the knowledge that it's finite in that sense. So it's to bring integrity into financial transactions. So crypto is an implementation. Is one of the applications of blockchain technology. Blockchain is a technology that is powered by what we call distributed ledger technology. And Bitcoin or crypto is just one of the applications. Blockchain is used in several spheres. In logistics, it's there. You'll be able to see that on this presentation. You'll be able to see it in healthcare. You'll be able to see it in real estate. You'll be able to see it in several other spaces. And of course, it's been used for different purposes and different reasons. There are different applications. So blockchain is a technology. It's not crypto, it's not blockchain at all.
Okay, that's good. Thank you so much. Types of blockchain?
Yes, so we have 4 types of blockchain. We have permissionless public, and these are blockchains that are accessible by anybody, and you don't need permission to be able to participate in the protocol or to be able to validate transactions within that particular network. So of course, some of those is Bitcoin and Ethereum. Of course, you can be able to join the network without having to be invited by anybody. Then we have permissioned public. These are public blockchains which anybody can access, but of course you have to meet a certain type of criteria. And obviously they use consensus mechanisms such as proof of stake, and of course, based on the stake that you have within the network, then that is what determines whether you're able to process or validate transactions within that particular network. So that's just it's permission because you have to meet specific criteria, but it's open to everybody. Then your permission is private. It means that it's a private blockchain that belongs to a certain organization, but any member within the organization is able to participate within to validate transactions within that particular database. So for example, you'd say it's a bank database, and anybody who is a bank member, including its customers, then they can be able to validate. So as long as they are customers within the bank, then they can do that. Then your permission private, it means that you have to be approved for you to participate in that particular network. And of course, they use what we call practical Byzantine fault tolerance, multi-signature consensus mechanisms for that. And permissionless private are basically what we call the federated agreement. So you saw the federated network is where you have a decentralized network, but to a particular centralized node, and then these nodes are connected to each other. So that's what we call a federated system. It's what is between what we call centralized and decentralized, and of course that is what those are the 4 types of blockchain. So any blockchain that is created out there, then it would ideally fall within these 4 types of blockchain. We can move next. So we can get to see some of the blockchains, and of course some questions have been asked around Bitcoin. So Bitcoin is a blockchain of its own, and Bitcoin is a form of digital currency that was founded during the financial crisis of 2009. So of course this is the story that we were making reference to, and Bitcoin is bank-free internet money. So Bitcoin is basically money that is not governed by any central bank. It is money that you as an individual, you are able to have what we call self-custody of it. So there is no bank or central authority governing Bitcoins. Even though Bitcoin seems very unlike the forms of currency you are used to, it still functions just like the money people use every day. You give your Bitcoin to someone, and they in turn give you goods and services. You can sell your lawnmower to your neighbor for a Bitcoin, just like you'd sell it. And you'll see from the next slide, the first Bitcoin transactions happened when someone bought pizza. So you can see that in the next slide. You'd see that, yeah. So this is essentially the nature of how a Bitcoin transaction life cycle is all about. And of course, you have to have what we call a wallet, which you open, and then of course you can be able to send, and of course there's a fee that you pay. So it works basically the same way mobile money works. But of course, once you do that and you sign that particular transaction, then there are network operators who we call the validators, whom we've explained before, who have to process that particular transactions, and that transaction has to be verified. And then of course money checks into the other part. So we can move forward to the next slide. So
there's another question.
Yes.
There's a student asking, who founded Bitcoin? Who are the founders of Bitcoin?
So people say Satoshi Nakamoto is the founder of Bitcoin, but obviously is not known to anybody, and that is always up in the air for speculation.
Wow.
Who Satoshi? Yes.
Wow.
So we couldn't say that. So most people are docs. Docs is unknown within the blockchain space. They don't want to be known, but and that's the beauty of blockchain. It's decentralized. You don't have to know who is behind what, because it becomes a community network once they are holders of that particular token. So for example, if you launch a token today and the community becomes the owner of the token, then it doesn't really matter who the owner is, because the community is in control of the network, and the network is governed by what we call smart contracts. And of course, these smart contracts are self-executing. So based on the controls that are being put on the smart contracts of a particular network, then you would see that the network is self-executing, and it doesn't really matter who is the owner or who initiated it. So that becomes a non-issue at all.
Perfect. And someone else asking the types of wallets. I think I can answer that. There is MetaMask wallet. There is Trust wallet. So those are the decentralized wallets, whereby the owner has the ownership to the keys, or to the paraphrase keys, correct?
Yes. Those are the decentralized wallets. They are called self-custody wallets, that you are your own bank. You become your own bank. And that's really the solution that was coming up with Bitcoin. So one thing we've said about Bitcoin is that it's not controlled by any central organization. So there's no CBK or central bank that is controlling the supply or the demand of Bitcoin. Really, nobody is doing that. And therefore, you become the bank, your own bank for that, through these self-custody wallets, such as MetaMask, Trust Wallet. There are several of them that are out there that you can be able to use. So you protect your wallet using what we call those paraphrase keys. Those are the ones that you protect your wallet with. So you keep your own money, and then you transact with your own money. Peer-to-peer means that you can transact with your friend, like, for example, the way Rob is sending it to Laura. So they're just doing it directly, right? And there is no bank that is maintaining the ledger. The ledger, remember, is public, and the validators are public. So they validate those transactions publicly. They are posted publicly. That 0.3 BTC was able to move from this person to this other person to this, and basically you are anonymous because you are identified using what we call wallet addresses. So that's it. So you don't know who is behind a particular wallet address, and that's the beauty of blockchain. And of course, we've spoken to the attributes of blockchain that makes that possible.
Great. There's someone asking, can I take you through the beginning to the end? So Rob opens his Bitcoin wallet, right? And his Bitcoin wallet is, let's say, like Trust wallet or Coinbase wallet, correct?
Yes.
This is the flow, right? And then they scan a copy to Raura. That's whereby Rob is sending 0.3 BTC to her friend. So using now the Bitcoin wallet, Rob scans the QR code, or they copy the address code, the Raura's address code, where Rob wants to send the Bitcoin to, correct?
Yes.
Then Rob fills the amount. Let's say they want to send now the 0.3, they fill amount, and then they set this Bitcoin now. This is the other step, and sets. And then now, this is now the transactions that happens behind the scenes. So this is the mining the hashtag. So where is this hashtag stored? So it's stored on the blockchain, correct?
Correct.
And how long does this process take from the beginning to the end? It takes a few seconds, correct?
Correct. So the transactions per second really depend on how the network is. If the network is crowded, that may take a little bit longer. But again, for your transaction to get preference to be validated, then obviously that's why sometimes you see you have to be charged, you pay some higher gas fees to incentivize miners to prioritize your transaction. So then that would mean you reduce the time of which the transaction cycles are made to validate your transaction. Yeah.
Perfect. I think that was explainable to everybody. So we can go on to the next slide.
Yeah, so of course, this is just showing the number of Bitcoins that are in circulation, and this speaks to the halving. So the halving, the halving basically is for these miners to process transactions. They're incentivized to do so, and of course, what they do every time they write a block successfully is that they are rewarded with a Bitcoin. So the number of Bitcoins, the mechanism of mining is called proof of work. It's called proof of work, where they employ machines for the purpose of being able to mine Bitcoin. And of course, that halving has been happening since 2009, and you can see how the reward has been going down, has been halving through the years. We just recently had another halving. And so how difficult that becomes, then that reduces the supply of Bitcoin. So blockchains differ in size of a block. Bitcoin's block size is limited to 1 megabyte or about 4,000 transactions. So that's forms one block. Given that the algorithm is fine-tuned so that only one block is added each 10 minutes on average. So on average, only one block is added to the so we can see a processing constraint of about 7 transactions per second. So of course we can see the Bitcoin network is not the most efficient when it comes to processing transactions, right? So of course the other ways. So the way that transaction will end up invalidated becomes infinitely small after a certain number of blocks included. So obviously the challenge is processing it, but this is dependent on the reward that the miners get because these are the persons who are processing transactions within this particular chain. Proceed.
Okay, great.
So of course, mining difficulty has been going up, and of course, obvious reasons because of the halving, and we just recently had another halving, and that's how the difficulty level goes up. So the difficulty, or the average number of tries it takes to verify the hash has been increasing since Bitcoin was introduced, using tens of trillions of average attempts to solve the hash. As this suggests, it has become significantly more difficult to mine a Bitcoin since the cryptocurrency launched, and of course, the more difficult it is, then the more difficult it is to mint new Bitcoins, and that makes it less and less in supply. So obviously that also increases demand with time.
And there is only 21 million Bitcoins in circulation.
Yes.
And over 18 million has already been mined.
Correct.
And with the new current situation, the Bitcoin ETFs, whereby the big institutions, they are able to buy Bitcoin through the Bitcoin ETFs. So that's one of the adoption of the Bitcoin.
Yeah. So the Bitcoin ETFs are geared towards reducing supply of Bitcoin in the market. So that's going to reduce supply because this is an ETF is an investment instrument. And therefore, when it's owed in Bitcoin, this Bitcoin is not trading. It's away from the exchanges. And what that means then is that we are likely to see Bitcoin becoming more scarce, with its mining becoming more difficult, then with Bitcoin ETFs and other investment products coming into play, then we are likely to see that there will be a huge scarcity of Bitcoins in the market. And of course, the fact that Bitcoin is widely now being used by several people to do various transactions, including just buying whatever it is that you want because of its huge liquidity, then of course we'll be able to see that the price of Bitcoin is going to go up, and people projecting it's going to hit $100,000.
Perfect.
Yeah, so this is the mind map, and of course you'd be able to see various use cases of of Bitcoin. It's a medium of exchange. Obviously, you can use it just as you use money. It's a store of value. You can people are actually saying it's the alternative to gold. If because of the nature of inflation that we're getting on our fiat currencies, then you can actually store out on Bitcoin, because based on the structure of scarcity that has been created, it is envisioned that the price will always go up because demand will always increase. So that is likely going to be so, because when it was built and within its smart contracts, the algorithms depict scarcity over time, and that is what makes it that it's going to go. So some of the projects we have is a Lightning Network. This is a real Bitcoin and it's a smart contract scripting language to enable secure, high volume and high speed Bitcoin transactions. So if you are aware about Lightning Network, it's a network that allows you to be able to send transactions, and it's one of the projects that is leveraging the Bitcoin network. Then you have the Liquid Network, you have the Omni layer, the Stacks, the wrapped Bitcoin, which allows for cross for blockchain interoperability. So some of the Bitcoin families, you have the BTC, which was launched in 2009, Bitcoin Cash in 2017, Bitcoin Gold in 2017. Then you have Bitcoin BSV and eCash. And of course, the ecosystem has the miners, it has the operators, the mixers, the hodlers, the whales, the exchanges, the P2P platforms. This is what forms that entire ecosystem of Bitcoin. Because all these are players within the space who are playing a specific role depending on their specific functions within the ecosystem. So this is the ecosystem, and of course, what you need to do is to go and do more research on the specific aspects of this if you want to dig deeper. And of course, you can be able to learn more around how the Bitcoin network has been set up. Yeah. But of course, we have other, moving forward, we have other blockchains. And of course, we have Ethereum. Let's go to Ethereum and look at